Welcome back, everyone. So today is June 1st, 2026, and we are witnessing an absolutely massive structural shift in the digital asset space. For years, the crypto narrative was completely dominated by high-risk, speculative trading, the wild west of finance. But as we look at the data coming in today, it's abundantly clear that we are pivoting into a highly mature era. We're officially entering the retention and utility phase. In today's explainer, we're going to connect the dots across the macroeconomic landscape, institutional security upgrades, and a literal technical renaissance happening right now on the Bitcoin network. We're going to break down exactly how this market is growing up, and more importantly, what it means for the future of digital wealth. Here is our roadmap for today. We'll start with a maturing crypto market, look at securing sticky capital, discuss the yield pivot, explore upgrading Bitcoin's utility, analyze real-world DeFi tests, and finish up with our market outlook. Let's get right into it. Section 1. A maturing crypto market, geopolitical relief, and price action. All right, that brings us to a dominant number today, $78,348. Bitcoin has aggressively surged past this level today. And this isn't just some random fluctuation. This price point really grounds us in today's market reality. We're seeing a powerful risk-on rally that is pushing Bitcoin back toward key historical resistance levels. But to understand why capital is holding firm right now, we really need to look at the structural market shift happening underneath the surface. Now, global relief rallies, like the recent reopening of the Strait of Hormuz, definitely help ease broader market fears. But the real story in crypto today is actually driven by internal market maturation. We are seeing centralized exchange spot volumes hitting multi-year lows. That means capital sitting on the sidelines, it's not looking for a quick, volatile trade anymore. It's looking for a permanent home. Section 2. Securing sticky capital, building brokerage-grade infrastructure. The contrast between the old market and the new market brilliantly illustrates this shift. On one side, you've got the old crypto playbook, right? Speculative trading, short-term flips, high risk, and just stomach-churning volatility. On the other side, we have the new crypto market, perfectly represented by Crypto.com launching digital native IRAs. Think about what this actually means. They are targeting the retirement market. They are allowing users to put a broad range of tokens into tax-advantaged vehicles specifically designed for long-term wealth preservation. It's a monumental shift from trying to capture day traders to capturing what we call sticky capital, the kind of money that parks itself for decades. But listen, if you want institutional and retirement money, you absolutely need institutional security. $559 million USDT. That is the record high that Bitget's exchange insurance fund just hit. Over $500 million acting as a massive security moat. To attract the kind of smart money that builds generational wealth, platforms have to prove they can withstand massive shocks. This incredible capital reserve acts as a giant safety net, assuring deep-pocketed investors that the infrastructure is rock solid. And we are seeing this exact same trend over at Bitget with their new VIP Fast Track program. They are practically rolling out the red carpet to onboard high-net-worth individuals and institutional holders. By providing streamlined access to both spot and futures liquidity, they're treating crypto not as a novelty, but as a permanent, highly liquid pillar of a diversified financial portfolio. The infrastructure is finally catching up to the asset class's ambition. Section 3. The yield pivot. Adapting to a low interest rate environment. Now, if you've been in DeFi lately, you've definitely felt this one. Yield compression. Standard simple staking rewards, the kind where you just lock up a token and sit back to earn a high APY, they are tightening everywhere. The easy money phase is over, guys. As more participants jump in and network efficiencies increase, those simple validator rewards just shrink. It's literally a case of evolve or die for these platforms. So, the crucial thing to watch is how the market leaders are responding. Take Lido, for example, the absolute giant of liquid staking. They've officially launched new vaults and earn products. They're moving away from relying solely on simple rewards and are instead shifting into structured, complex yield management layers. By using advanced liquid staking strategies, they're helping investors keep those returns high even as base yields compress. It's essentially DeFi preparing for a broader, low-interest rate environment by acting a lot more like sophisticated traditional finance. Section 4. Upgrading Bitcoin's utility, the technical renaissance. Okay, this is the acronym you absolutely need to know today. OP_CAT, or Bitcoin Improvement Proposal 347. It is a proposed script operation that would enable something called Bitcoin covenants. Simply put, it lets developers program rules on exactly how a Bitcoin can be spent in the future. This unlocks native smart contract-like functionality right on Bitcoin. We're talking advanced vault protections, recurring payments, complex transaction logic, the whole shebang. And the best part, it doesn't require a massive, risky overhaul of the base layer. It creates a real builder's premium for the network, evolving Bitcoin's utility far beyond just holding it. Section 5. Real-world DeFi tests, navigating crises and building trust. Let's talk about the recent $23 million exploit on Resolv Labs. In the past, an exploit like this would have triggered sheer panic and total collapse. But look at the logical, chronological sequence here. The exploit happens, the team immediately pauses the protocol, the USR stablecoin depegs, which is totally expected, and then a brand new recovery protocol is transparently initiated to stabilize the asset. This is a vital stress test for the industry. It proves that DeFi protocols are actually learning how to successfully navigate depegging events and restore user trust through technical transparency rather than just pulling the plug and shutting down. To really grasp the stakes of these recovery protocols, we can look at the hypothetical stress tests the industry debates daily, like potential large-scale protocol exploits such as the drift protocol situation. In these scenarios, the community constantly debates how major stablecoin issuers should react. Do you want an entity stepping in aggressively with recovery funds, or do you want strict censorship resistance, even if it brings on heavy legal scrutiny? It really highlights the ongoing debate over what users actually expect from their digital dollars when a crisis hits. And on the brighter side of real-world testing, we have platforms like Bitget launching their payment processing system. This is a real-world test of crypto going toe-to-toe with traditional retail. By offering low-fee crypto-to-fiat settlements, specifically designed for online businesses, it provides a direct, decentralized alternative to those high-fee credit card processors. It is everyday utility right out in the open. Section 6. The market outlook. Will the floor hold? First off, keep your eyes glued to the Bitcoin dominance metric, which is currently sitting at a commanding 58.3%. You see, in a mature market, Bitcoin remains the gravitational center. When dominance is this high, it tells us that institutional capital, that sticky money we were just talking about, is prioritizing the security and liquidity of the flagship asset way over speculative altcoin plays. So, here's your bottom line. The two major catalysts to watch right now are developer traction on the OP_CAT proposal and the initial inflow data into products like Crypto.com's digital native IRAs. If builders keep flocking to Bitcoin's new utility, and if retail and institutional wealth starts pouring into those tax-advantaged holding vehicles, we are going to see a truly powerful alignment. I want to leave you with this question to chew on. Is this influx of institutional, sticky capital and enhanced utility finally enough to turn Bitcoin's historic $78,500 resistance into a permanent floor? Are we finally done with the wild swings and stepping into an era where digital assets are a foundational, unshakable layer of the global financial system? The data certainly points that way, but I want you to look at these catalysts and decide for yourself. Thank you so much for joining me on this explainer. Keep learning, keep analyzing, and I'll catch you in the next one.